Nilesh, hi, good afternoon and welcome to Markets at Lunch. How do you feel about the valuations at this point of time? There's been a fair amount of correction in the markets. Do you feel more comfortable at this point of time? Would you recommend your clients also to park their monies in the markets?
Yeah, so if you look at the history of the fund, the Quantum Long-Term Equity Fund, we were sitting on almost 20% cash just 2 months ago, given that we were uncomfortable with the valuations. But given the correction that has happened in the last 2 months, we have found opportunities to deploy that cash in select pockets where valuations have fallen quite rapidly. So our cash levels are now down to 10%. And when we look at the upside potential of the portfolio, it looks like there's fairly decent upside over the next 2 years. So at least our advice to investors has been now is a good time to allocate to equities. Which was not the case 2 months ago.
All right. Could you also talk to us about why is it that you're betting on cement as a business? What is it? What are the triggers or levers that you think are likely to fuel the up move for these stocks?
Yeah, so we've always been wary of valuations. So if you look at some select companies, they've started trading at a discount to replacement cost, which is a good entry point into these companies. Traditionally, if you've entered these companies at that level, by and large, you've been able to make your long-term returns. So given the correction, some of these companies have started trading at a discount to replacement. And our sense is once the cycle reverses, they will again move back to their premium valuations. So hopefully we'll make our returns over that cycle. So our entry point into cement primarily has been driven by valuations, where we believe right now there is adequate margin of safety and we don't see much downside risk from current levels.
Let's also talk about consumption. We've been chatting with our guests earlier on in the day as well about what are some triggers because of which, what are the key dampeners, not triggers in fact, which have actually dampened the entire consumer sentiment. Diwali, even Navratri has been fairly muted, and as we approach closer to Diwali, experts and even retailers are not seeing too much of a pickup. Do you think Q3 could be rather weak this time around as far as the entire consumption basket is concerned?
Yeah, it's actually been very difficult to gauge what is happening on the ground given the distortions that have happened in the numbers. So last year we had the GST in Q2, so the Q2 numbers looked relatively okay, but because of the base effect, the numbers were probably higher than what they should be. So Q3 you will get a real sense of what is happening on the ground. So initial readings suggest that it could be weaker than what people think. It looks like festival season has not gotten off to a great start. But anecdotally, when we go and meet companies now versus a year ago, a lot of them are suggesting there is some sort of pricing power coming back to them, and at least demand on the ground seems to be a lot better than it was probably a year ago. So our sense is we are somewhere close to in the early stages of a pickup in consumer demand. Q3, Q4, we don't know, but it looks like we are at the cusp of a pickup in consumer demand, and at least consumption should pick up from where it was, or at least from where we were a year ago.
Okay, Nilesh, thanks much for taking time out and helping us understand what are some themes that are looking good at this point of time, and even the perspective that you've given on valuations.